Welcome to the Retirement Wealth Podcast. We're so glad to have you with us today. If you're thinking about retirement, or maybe you're already enjoying it, you know how crucial it is to plan wisely.
Absolutely, Emily. And let's be real, retirement planning can feel overwhelming sometimes. There are just so many choices to make, and mistakes can be costly.
Right? I mean, no one wants to look back and think, I wish I had done that differently. So today, we're diving into some common retirement planning mistakes and how to avoid them.
We'll cover everything from underestimating expenses to not having a solid withdrawal strategy, plus some tips on how to stay on track as you approach retirement.
And we'll also touch on the importance of having a well-diversified portfolio and, the role of Social Security in your retirement plan.
Those are critical points, and understanding them can really make a difference in your financial future.
So whether you're just starting to think about retirement or you're already in the thick of it, there's something here for everyone.
Let's jump right in, shall we? The first mistake we often see is, Emily, when we talk about common retirement planning mistakes, it's really crucial to emphasize why this is so pressing right now. I mean, we're living in a time of significant change.
Absolutely, David. With everything from inflation spikes to market volatility, it's like planning for retirement today is a whole different ball game than it was just a few years ago.
Right? Take inflation, for instance. Many retirees are feeling the pinch more than ever. I mean, just last month, I was speaking with a client. Let's call her Susan. She's in her early 60s and is planning to retire in a couple of years. She was shocked to see how much her grocery bills had increased over the past year, and it really got her thinking about her retirement budget.
That's so relatable. I think a lot of people are in that boat right now. Susan must be worried about how these rising costs will affect her retirement income.
Exactly. And it's not just groceries. Healthcare costs are another big concern. A study showed that a couple retiring today might need around $300,000 just for healthcare expenses throughout retirement. That's a staggering number.
Wow, that is a lot. So planning for those expenses is essential. If someone hasn't factored that into their retirement strategy, they could be setting themselves up for some serious financial strain.
Definitely. And don't forget about the market volatility we've been seeing lately. Many people are still feeling the impacts of the stock market fluctuations from the past couple of years. I had a client, Tom, who had a significant portion of his retirement savings in stocks. After the downturn, he was understandably nervous about whether he could retire as planned.
Yeah, that's tough. I can see how that would shake a person's confidence. It's like, if your portfolio takes a hit, you might start to rethink your entire retirement timeline.
Absolutely. And that's why it's so important to have a diversified investment strategy that can weather these fluctuations. Not to mention, keeping an eye on tax efficiency. I mean, with potential changes in tax laws on the horizon, retirees need to be proactive about how their savings are structured.
For sure. And speaking of changes, Social Security is another area that's been in the news a lot lately. With the trust fund projected to deplete in the coming years, many are worried about how that'll impact their future benefits.
Right, and it's not just about the numbers either. There's a lot of uncertainty surrounding what benefits might look like in the future. I had a conversation with a couple, Jane and Mark, who are counting on Social Security to cover a significant portion of their retirement income. They were concerned, and rightly so.
I can imagine the anxiety it can cause. It's like, what do you do if you can't rely on that income as much as you thought?
Exactly. That's why we always encourage people to have a backup plan. You need multiple income streams, whether it's pensions, savings, or, part-time work. It's about building a safety net.
And let's not forget about legacy planning. With so many people wanting to leave something behind for their loved ones, it's crucial to have that discussion early on. I think many don't realize how important it is to include that in their retirement planning.
Right. I recently met with a widow, Barbara, who had been so focused on her own retirement needs that she hadn't thought about what would happen to her estate. She had significant assets, but hadn't put together a plan for her children. It's a huge emotional aspect of retirement that often gets overlooked.
That's so true. People think about the numbers, but the emotional side, how you feel about your finances and what you're leaving behind, is just as important.
Exactly, and that emotional security can really impact how you enjoy your retirement. If you're constantly worried about finances, it can overshadow the joy of retiring.
Yes, and with the current economic trends, like the rise in interest rates and ongoing inflation, it's more important than ever to be strategic with your planning.
For sure. We're seeing how these factors are intertwining, affecting everything from spending habits to investment choices. We've got to adapt our strategies to navigate this landscape.
So would you say that this is a pivotal moment for people who are planning for retirement, or even those who are already retired?
Absolutely. It's like the decisions made now will have ripple effects for years to come. You really can't afford to sit back and hope for the best anymore.
Right, you've got to be proactive and informed. It's all about being prepared for whatever comes your way.
Well put, Emily. And I think that brings us to the next step. How do we implement strategies that can help mitigate these risks and prepare for a secure retirement? So, Emily, let's dive into some of these core strategies and rules of thumb that can really help folks navigate their retirement planning. You know, one of the first things that comes to mind is the 4% rule.
Right, that's a classic. It's basically a guideline suggesting that if you withdraw 4% of your retirement savings each year, you should be able to fund your retirement for about 30 years without running out of money.
Exactly. But it's important to remember that the 4% rule isn't a one-size-fits-all solution. I mean, it's based on historical market performance. So if we hit a rough patch, that 4% might be too aggressive for some people.
Yeah, and it can vary depending on your personal circumstances, right? Like if you have other income sources, or if you're planning to retire early or live a really long time.
Absolutely. That's why it's essential to have a flexible withdrawal strategy. Some people look into the bucket strategy, which segments your retirement savings into different buckets for short-term, medium-term, and long-term expenses.
Oh, I love that idea. It kind of takes the pressure off, doesn't it? No, having your short-term needs covered without worrying about the market fluctuations affecting your long-term investments.
Exactly. So for instance, you might have one bucket that covers the first few years of retirement with cash or bonds, and then another bucket invested in stocks for the longer term. That way, you're not forced to sell your investments in a downturn.
That makes a lot of sense. Speaking of investments, let's talk about asset allocation. How do you think folks should approach that in retirement?
Well, a common rule of thumb is the 100 minus your age guideline. So if you're 65, you should have about 35% in stocks and 65% in bonds. But again, this can vary based on individual risk tolerance and financial goals.
Right. And some people might feel more comfortable with a 70-30 split, especially if they're healthy and expect to live a long time. It really comes down to balancing growth potential with stability.
Exactly. And don't forget about diversification. You want to spread your investments across different asset classes to reduce risk, like investing in a mix of domestic and international stocks, bonds, and even real estate can help smooth out the bumps in your portfolio.
That's a great point. And speaking of real estate, how does that fit into a retirement plan? I mean, it's a big investment, but can also be a source of income.
Right. Real estate can be a fantastic asset in retirement if managed correctly. If you own rental properties, they can provide a steady income stream. Just keep in mind the associated costs, maintenance, property taxes.
And don't forget about the potential for market fluctuations. It's not always a guaranteed income.
Exactly. And then there are tax-advantaged accounts like 401ks and IRAs, which play a critical role in retirement planning. The tax treatment can significantly affect your withdrawals in retirement.
For sure. With a traditional 401k or IRA, you're deferring taxes until you withdraw funds, while with a Roth IRA, you pay taxes up front, but withdrawals are tax-free in retirement.
And that can be a huge advantage. Imagine being in a lower tax bracket in retirement. You could strategically withdraw funds from your Roth to minimize your overall tax burden.
Right. And then there's Social Security optimization. It can be confusing for a lot of people.
It is. The age at which you claim Social Security can impact your benefits significantly. Claiming early at 62 means you could receive a reduced benefit, whereas waiting until 70 can increase your monthly payout by up to 30%.
Wow, that's a big difference. So it's really about figuring out what works best for your overall retirement income plan.
Definitely. And you should consider your health, longevity in your family, and other income sources when making that decision.
And don't forget about required minimum distributions or RMDs for those who have traditional retirement accounts.
Right. Once you reach age 73, you're required to start taking distributions from those accounts, which can impact your tax situation. Planning for that is crucial.
So how can someone prepare for those RMDs?
Well, one way is to have a mix of taxable and tax-advantaged accounts, so you can manage your withdrawals more effectively. Also, being strategic about your withdrawals can help minimize the tax impact.
That's really smart. And I think it's also important to revisit your financial plan regularly, especially as the market changes and your personal circumstances evolve.
Absolutely. A good practice is to review your asset allocation at least annually or whenever there's a significant life event. It's easy to get complacent.
Right, and making adjustments can help keep you on track with your goals. So David, as we wrap up this part, what common mistakes do you see people making that we haven't touched on yet?
Well, one major pitfall is underestimating healthcare costs in retirement. Many people don't realize how expensive long-term care can be, so it's crucial to plan for those potential expenses.
That's a huge one. And I think many people also overlook inflation. What might seem like a comfortable withdrawal today may not hold the same value in 20 or 30 years.
Spot on. And not having a clear strategy for when to claim Social Security can lead to leaving money on the table.
All great points, David. It's clear that careful planning and awareness of these common pitfalls can make a world of difference in achieving a secure retirement.
Exactly. The more informed and proactive you are, the smoother your retirement journey will be.
Well, I think that wraps up our discussion on strategies and rules of thumb for retirement planning. Let's transition into some of those common pitfalls that people should really watch out for.
So, Emily, I think one of the biggest pitfalls people face when planning for retirement is really understanding the sequence of returns risk. It's not just about how much you save, but also the order in which those returns happen, right?
Exactly. I've seen so many folks caught off guard by this. They expect consistent growth, but if they experience a market downturn early in their retirement, it can really throw a wrench in their plans.
Right, and I remember working with a couple. Let's call them Tom and Lisa. They retired in 2008, right around the time the market took a nosedive. They had saved diligently for years, but that initial drop really impacted their withdrawal strategy. They were pulling money out when their investments were down.
That's tough. So what happened to them?
Well, they had to adjust their lifestyles significantly. They ended up cutting back on travel and other activities they'd planned for. If they'd had a better withdrawal strategy that considered sequence of returns risk, they might have been able to avoid that.
It's such an important lesson. So how can someone spot red flags early, David?
A good starting point is to regularly review your portfolio's performance and your withdrawal strategy. If you notice your investments are down significantly, it might be time to reassess how much you're taking out.
That makes sense. Another common mistake I see is ignoring taxes when planning withdrawals. It can be so easy to overlook how much taxes can eat into your retirement income.
Absolutely. A lot of retirees don't realize that withdrawing from tax-deferred accounts like IRAs can push them into a higher tax bracket, which can be a shock during tax season. I once had a client, let's call her Susan, who was only focusing on her gross income without considering the tax implications.
Oh no! What happened with her?
Well, she ended up withdrawing more than she needed to, which increased her taxable income considerably. She didn't account for the taxes and ended up with much less than she anticipated after the IRS took its cut.
Wow, that must have been a tough lesson. So what advice do you give to clients about managing withdrawals and taxes?
I always recommend a tax-efficient withdrawal strategy. It's crucial to plan which accounts to withdraw from first. For instance, consider withdrawing from taxable accounts before tax-deferred ones. That way, you can minimize your tax liabilities.
That's really helpful. Another area I think people underestimate is healthcare costs and longevity. It's a big one, isn't it?
Definitely. For many retirees, healthcare can be one of the largest expenses they face. I had a client, let's call him John, who thought he'd budgeted enough for healthcare, but he completely underestimated his medical expenses, especially after he turned 65.
What did he miss?
Well, John didn't account for things like long-term care or the rising costs of prescription drugs. It added up quickly, and he found himself dipping into his savings much sooner than expected.
That's a real eye-opener. So what's a good way for people to prepare for those unexpected healthcare costs?
I always suggest that people start by researching healthcare plans early and consider setting aside a separate health savings account if they're eligible. Also, looking into long-term care insurance can be a lifesaver.
Those are solid tips. Now, what about asset allocation? I imagine that can lead to some pitfalls too.
For sure. A common mistake is being too conservative or too aggressive in their asset allocation. I had a couple, let's call them Mark and Jenna, who were nearing retirement and they felt they should be super conservative, so they moved almost everything into bonds.
And was that a good move?
Not really. They didn't account for inflation and ended up losing purchasing power over time. Their returns just couldn't keep up. A balanced approach can help mitigate risk while still allowing for growth.
It sounds like finding that balance is crucial. How can someone determine the right asset allocation for them?
I always advise clients to consider their risk tolerance, investment goals, and time horizon. A financial advisor can really help create a personalized plan that aligns with those factors.
That's great advice. Now, let's touch on Social Security. Claiming benefits too early can be another mistake, right?
Exactly. Many people are tempted to take Social Security as soon as they can at age 62, but that can have long-term consequences. I had a client named Carol who did just that. She needed the income, but by claiming early, she locked in a lower benefit for the rest of her life.
That's a big deal. So what's your advice for those thinking about when to claim?
It's important to weigh your options carefully. Consider your health, your financial needs, and the potential benefits of waiting. Sometimes, delaying can significantly increase your monthly benefit.
That's really insightful. So as we wrap up this discussion on common pitfalls, what are some practical next steps for people to take?
Well, first and foremost, I'd say do a thorough review of your retirement plan. Assess your asset allocation, review your withdrawal strategy, and think critically about your healthcare needs.
And don't forget about taxes.
Exactly. It's all interconnected. Also, consider working with a financial advisor who can help you navigate these complexities and create a comprehensive strategy that's tailored to your unique situation.
Those are fantastic suggestions, David. I think listeners will find a lot of value in these insights.
I hope so. It's all about being proactive and making informed decisions. That way, you can enjoy a more secure and fulfilling retirement.
Absolutely.
All right. So now that we've covered some common mistakes, let's dive into the next steps and tools that you can use today to improve your retirement planning.
Absolutely. There's really no better time than now to start making those adjustments. So what's the first thing folks can do?
Well, one of the easiest steps is to review your current retirement accounts and contributions. You can use platforms like Vanguard, Fidelity, or Schwab. They all have retirement calculators that can help you see where you stand.
Right, those calculators can really provide a clear picture. It's like a snapshot of your financial health, isn't it?
Exactly. And I think running those projections is key. It helps you understand if you're on track to meet your retirement goals. It's also a good idea to check in on your asset allocation.
Yeah, and I've heard that a lot of people forget to adjust their portfolios as they get closer to retirement.
Yes, and that can be a big mistake. A simple habit to start is to review your portfolio at least quarterly. Just take a moment to assess if your investments still align with your risk tolerance and retirement timeline. It doesn't have to be a huge commitment.
That sounds manageable. What about folks who might be worried about taxes in retirement?
Great point. It's essential to consider the tax implications of your withdrawals. You can visit ssa.gov for information on Social Security benefits and how they may be taxed. Plus, using tax software can help you plan your withdrawals strategically.
I love that. Speaking of planning, are there any apps you recommend for tracking expenses or budgeting in retirement?
Absolutely. There are some great financial planning apps out there, like Mint or YNAB, which stands for You Need a Budget. They can help you keep an eye on your spending and savings goals.
And that's so important, especially in retirement, when you want to stretch your savings as far as possible.
Exactly. Another useful tool is to start a retirement book club if you like reading. There are some fantastic books on retirement planning that could really inspire and inform you.
Oh, I love that idea. What are some titles you think are must-reads?
The Total Money Makeover by Dave Ramsey is a classic, and How to Make Your Money Last by Jane Bryant Quinn is also excellent. And if you prefer podcasts, The Retirement Answer Man is very popular and full of tips.
Those sound great. Now, for someone who might feel overwhelmed, what small habits can they start right away?
Even just spending a few minutes each week reviewing your financial outlook can make a difference. Start with running those retirement projections, or maybe setting up automatic contributions to your retirement accounts.
That's a good one. Automating can really take the pressure off, right?
For sure. And don't forget, it's never too late to improve your plan. Even if you're nearing retirement, making small changes can have a lasting impact.
Absolutely. It's all about taking those little steps, right?
Exactly. And I think it's also important to talk to a financial advisor if you haven't already. They can provide personalized advice that considers your unique situation.
Yeah, having that professional guidance can really help you navigate through the complexities of retirement planning.
It sure can. And remember, it's about having a plan and being flexible. Life can throw curveballs, and adjusting your plan accordingly is part of the process.
Very true. So, with all these tools and habits, listeners have so many options to take charge of their retirement planning.
Exactly. With these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today. Well, Emily, as we wrap up this conversation about common retirement planning mistakes, I think it's important to highlight a few key takeaways.
Absolutely, David. One of the big ones is starting to plan early. It's never too soon to think about your retirement.
Right, and along with that, making sure you have a diversified investment strategy. Relying too heavily on one source can really put you at risk.
And let's not forget about the importance of having a solid withdrawal strategy. Like knowing how much you can take out without jeopardizing your nest egg.
Exactly. Also, keeping an eye on those healthcare costs can't be overlooked. They can sneak up on you if you're not prepared.
Yes. And staying informed about Social Security options is crucial too. It's like understanding how and when to claim can make a huge difference in your income.
All of these points really emphasize the need for a proactive approach to building and protecting your retirement wealth.
For sure. And it's all about making informed decisions that align with your personal goals.
Absolutely. Remember, it's your future, and investing the time now can lead to a much more secure retirement.
If you found value in today's discussion, don't forget to like, subscribe, and share your thoughts. We'd love to hear your biggest takeaway or any questions you might have.
And if you know someone who's planning for or is already in retirement, share this episode with them. It could really help.
And next time, we'll dive into how to create passive income streams for retirement. It's going to be a great episode.
Yes, looking forward to it.
Thanks for joining us today. We appreciate you spending time with us, and we'll see you next time.
Take care, everyone.